U.S. nat gas prices experienced significant movements last week, driven by Hurricane Helene and its impact on production in the Gulf of Mexico. Meanwhile, Hurricane Helene, which made landfall in Florida as a Category 4 storm, knocked out power to 4 million people. While this temporarily reduced demand, production in the Gulf of Mexico remained stable. Data showed a 6.8% increase in the Gulf of Mexico output day over day, with total U.S. production holding close to 100 billion cubic feet per day. The current situation clearly demonstrates how speculative the natural gas market can be. On one side, traders are speculating on potential supply disruptions and a slight reduction in Gulf gas production, amounting to 0.36 billion cubic feet per day. On the other side, Gulf Coast LNG facilities remain unaffected, total U.S. gas production is steady, and widespread power outages across the Southeast have left millions without electricity in Florida, Georgia, and the Carolinas. Moreover, the U.S. nat gas rig count rose by 3, from 96 to 99, indicating that energy companies have begun ramping up gas production in response to the recent price surge. Additionally, major players like hedge funds and money managers have been steadily reducing their long positions since August 9. What will truly impact natural gas prices later this year, as I've highlighted numerous times in my analysis, is the continued swift decline in the storage surplus. Currently, it's decreasing at a rate of around 3 billion cubic feet per day and is expected to dissipate by the end of the year. However, this is a gradual process which should steadily push the average gas price higher as we approach February. Based on these fundamental factors, the current price spike appears to be purely speculative, and I anticipate the gas market will encounter bearish pressure in the coming week. Although production remains stable and storage levels are strong, weak demand due to mild weather across much of the U.S. continues to weigh on prices. The impact of Hurricane Helene on demand from power outages is likely to overshadow any short-term supply disruptions. Friday's uptick appears speculative and questionable, suggesting that this price spike is likely to be short-lived. Prices may struggle to hold above the $2.60 support, with any further gains likely capped between $2.60 and $2.70 in the event of an unexpected rise in demand or supply tightening. Otherwise, downside risks persist. Short selling pressure is likely to increase if prices fail to break higher, limiting near-term gains. The 200-day moving average at $2.40 is serving as the main support and an attractive entry point for potential buyers ahead of winter, when they could benefit from seasonal demand and secure profits later. Please like, subscribe, and comment to support the channel. See you in the next one.